Hello, I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us for this Market Carver here as we close out October and head into November. We want to just take a few minutes here and kind of break down where we're at in markets. Each week, we're kind of hitting some of the major topics we talk about in each week's investment meeting. But this week, we realized we want to kind of put a succinct message, really dissecting where we're at inside of the year in terms of stocks and bonds and how we should think about things going forward. So we're going to start off, we're going to talk about the 60-40 portfolio, something we refer to a lot. That's just shorthand for balanced. We'll hit that in just a second and where it's at in terms of performance. Take a look specifically at bonds, and then Andrew will hit a couple of different measures on where we are at on stocks. So a lot of this has been repeat material, but in a very I think very defined format here and a very distinct purpose. So let's start off talking about the 60-40 portfolio. And just to have us on the same page here, when we say 60-40, what we mean is just a simple balanced portfolio where 60% of the money is in stocks and 40% is in bond. Very basic, very foundational, even to our balanced portfolio. Not that it will always be invested that way, but it's a good home base. And the first point we want to make here is the understanding that we are just at a really significant part of this cycle, one that puts it on path with really two of the other major declines that we've seen going back to 2000s. Of course, many people refer to the 2000s as a lost decade for investors. When you look at things from a real return perspective, which is something important to us, when we say real return, those words simply mean that we're backing out the effects of inflation. Ultimately, what matters is not just the value of your portfolio, but what the value would be in real terms, in terms of maintaining its purchasing power. So in each of these cases here, we're measuring the value of these portfolios in real terms, netting out the impact of inflation and where it is from the starting point of that cycle. So in each of these cases, we're looking at the high point in the cycle. So the first line, that blue one there, is going to be marked the dot-com era. We had a huge run up in tech stocks in the late 90s. Then we had them bust in the early 2000s. That was really marked the first of the major declines. Then we had the great financial crisis. That's the orange one. And so in each of these cases, we're measuring from the high. And then the gray is going to be measuring the present era, where we peaked in December of 2021. And we've seen a pullback in stocks and in bonds, along with firmer inflation than we saw in those prior to decreases. And so where we're at right now in that gray line, and if we were to update this is through September 30th. If we were to update it as of now, factoring in the rise in interest rates during October so far, the gray would be below both the orange and the blue line. So what that means is at this point in the cycle, which would be month 2022, 22 months after the peak, we're lower than both of those. So I would say that the great financial crisis had a lower bottom, at least at this point in time. And Lord, let's hope we don't exceed or match that one. In the blue, we ultimately went on to a lower level. But at this point, it's worse off than those two majors. So to me, that just tells us how it feels to be an investor at this point in time. Now, the other thing that I would say, the 60% here is in S&P 500 only. We don't want investors to think that way. That's a very dangerous way to look at multiple market cycles. So that means a couple of critical things. Number one, the blue line there, the .com, would be far less severe, far less severe if it was balanced in its equity orientation. It was really the inverse of what we have here in this present era. Other things like small caps, international stocks did not drop near as much as the S&P 500. So a more balanced approach or a more diversified would not have been that severe. And furthermore, the gray bar, if it had been not the S&P 500 or more diversified, it would be far worse. All right, add those all together, and we know we're at a pretty pain point. That doesn't mean that we've marked the bottom of this one or that we're conversely on the way up. It's just simply a measurement of where we are in terms of pain points. Now, one of the things we mentioned that has made this one as, it's tough to think of these in the same light as the decrease in the 2000, 2007. But one of the main factors besides the higher inflation is this next chart, which is the bond market. Has been the driver. The fact that it hasn't increased like it did in 2007, like it did in the early 2000s, it acted as a ballast or a stabilizer. Bonds have actually added to the pain. So last year, we've of course hit so many times, being by far the worst ever for bonds. And this year has just been a letdown because we started off on what was at the time, through January, early February, one of the best starts to a market we'd ever experienced. And now, as you go through, that is the blue line. As you get to this point in the year, we've actually on pace or very close to being the second worst year for bonds, following up last year's disaster. So that is really added to the pain. Now, on a positive note, and I just can't emphasize this as much, we really hit it probably not as much as we should, as really milestones that we've reached in bonds and really a turning point. If you go back to the beginning of 2022 and most of this cycle, we've had a very cautious, very defensive mindset towards bonds. Have not felt good about owning them, but we're feeling very differently about that now than we were at the beginning of those cycles. Not that we're going to see a reversal or a turning point, but for the first time in a long time, we see some attractiveness in bonds to where we want to be more aggressive, and we've been adding to those positions. For those of you who get your trade confirmations in the mail, you'll be wondering why you've had so much activity. A lot of it has been taking advantage of interest rates, which have got to 5%. So some questions we get, or a question we get a lot, is why do we not want to just own CDs? You can get close to 5% for a one-year CD, and that looks very attractive, especially in the midst of having that 60-40 portfolio, again, on pace with those other devastating eras. One thing we just don't hit enough is really what you're missing out is what is available now on the bond side. So with interest rates above 5%, and when you add the sort of bonds that we have in the portfolio, which are heavy in mortgage-backed securities, things that have additional income relative to those treasuries, that's one thing you miss out if you don't own CDs. Now, if you would look at the bond portions of your portfolios that we have you positioned in, you would find the yield on those between 6.5% and 7%. It depends on what the day is. So I just wanted to remind you here, and that is really a favorable outlook going forward. So that is the bad news is that we started out with essentially no interest rate. That produces a very negative and a very nasty bond environment. When you start out with these much fatter yields, we feel very differently going out the windshield than we do looking in the rear view mirror. That's really the bond impact of it. And I'll ask Andrew to really unpack the stock side of it, which is, of course, adds a little bit to that pain. So Andrew, I'll turn it over to you and your two charts.
All right, thank you, Adam. So whenever we talk about the stock market, it really is a market of individual stocks. How these different stocks perform, whether they go up a lot, whether they go down a lot, whether they go nowhere, really determines what the index does. Now, because the index, when we talk about indexes, we're often talking about the S&P 500, is weighted, each stock in it is weighted by the size of the company, which we would use the market cap of each stock. And so with the largest companies seeing so much growth over the last 10, 15 years, we've seen the biggest companies in the S&P 500 become a larger and larger weighting to the index. Now, oftentimes we have kind of an issue with that. We think we don't want there to be too much weight on just a handful of stocks. If these stocks don't perform well, then we're going to see the index not perform well. Now, we've seen actually the reverse of that this year, where just these handful of stocks, these handful of mega cap stocks have done exceptionally well. In fact, it's really been everything else that hasn't been able to really keep up or perform as strong throughout the rest of 2023. So the chart that I want to share with you kind of breaks the market apart a little bit. So the first chart on the very top, we have that cap-weighted S&P 500, the market. Whenever we talk about the market, the 500 largest stocks. The middle part is what has been dubbed the Magnificent Seven. These are some of the largest companies in the world. We're talking about Apple, Nvidia, Meta, which would be Facebook, Amazon, Microsoft, Google, and Tesla. These are some of the largest stocks and some of the best performing stocks in the large cap universe year to date. Now, on the bottom part is a little less bullish, a little less encouraging. This is the performance of the whole market, of all 500 stocks, and the percentage of them that have been positive year to date. And so as we've seen the market peak back at the very end of July, we've talked about some of the seasonal impact of that. We had a rough August, a rough September, and now in October, we're seeing stocks really gyrate quite a bit, some big up days and some down days. during that period, we're actually seeing the majority of stocks now are negative. You can see on the chart there, roughly 44% of the S&P 500 actually is below its watermark for the year. It's because the significance of those magnificent seven, just those seven stocks alone, have really been able to carry the weight, carry the water for the whole index, and why it's so important to watch how they're performing. And so on that chart, you can see I've drawn some red lines. We're seeing kind of a consolidation in the stock price activity for those huge mega cap names, and really how that consolidation ends, whether we see a break higher or a break lower, is really going to be significant for the overall market. Should we see these seven stocks continue to perform really well? We're kind of in the middle of earnings season. A lot of them actually report today. We record this video on a Tuesday. So we're going to get a lot of earnings announcement, a lot of good insight into the health of these companies. If they do really well and they start to rise, that should help buoy the rest of the market because so much weight is put on just these handful of stocks. Now, if we see the counter of that, if we see just these handful of stocks start to break down, break below those summer lows, then that's going to start kind of being a gravitational pull for the rest of the market, because we already see a lot of the other smaller stocks already are negative for the year. And so if we start to lose the participation, lose some of the ground that's being held by these mega cap stocks, then that's going to be a bearish development for the overall market. Now, another way we can kind of dissect the market is group everyone in different sectors. There's 11 sectors in the S&P 500. Think technology, utilities, consumer staples, healthcare, energy. All these are different sectors, and all these stocks flow into their sector. And so we can look at the performance of those sectors year to date as well. And so this chart is doing just that. So these are looking at certain ETFs. So in the top, we have XLC, that's communications, technology, consumer discretionary. Those have been the best performing sectors. And if we looked under the hood of those sectors, we would find that's where these magnificent seven are. That's where we find stocks like Amazon, Tesla, Apple, Google. They all make up the lion's share of those top three sectors. But when we start looking further down that chart, we can actually see that the majority of sectors are negative on the year. We have, you can see utilities, real estate, consumer staples. A lot of these sectors actually are also negative on the year. Meanwhile, the broad market is up 10%. Why this is important is when we talk about the market and how it's performing and how different sectors or stocks are doing, it really depends on what perspective, what part of the market you're looking at. If we were just looking at those growth technology names, then they've had a very strong year. If in the case we were looking at more consumer staples, the companies that you're seeing at the grocery store, utility companies, real estate companies, they've had a much tougher year and have actually seen double-digit, in some cases, double-digit declines. And so when we put all this together, this is what creates the S&P 500. This is what creates the stock market in America. And so we want to always try to see, and when we're building the portfolios, is where can we see the market is showing strength? So we have our sector rotation models. We have different ways to analyze to see where the strength is being showing up in the market and try to best position ourselves in those corners of the market while respecting the amount of risk we're taking, respecting some of the analysis and the fundamentals and all the different sources of data that we take in to make portfolio decisions. But we can see this year has been very unique in that it's been very bifurcated in the performance from an individual stock level as well as a sector level. And some areas getting rewarded much more heavily than others, as we can see on this sector chart here on the screen. And so as we move into the end of the year, we're starting, like I said, starting to get into earnings season. Favorably, seasonality starts to kick in November, December. Typically, stocks do better, but we also have a lot of other outside impacts. What's going over on in the Middle East, what's going on here at home within our own political system, what's going on with interest rates, and all these different things are feeding into the stock market that we have to be able to digest and see what their ultimate impact will have. And that's why our job really is to focus solely on these portfolios and looking at the amount of risk that we're taking and trying to serve you as best as humanly possible.
Yeah, very, very well put, Andrew. And just couldn't thank you all enough for giving us your time and your trust. Just put a wrap on it. I think we've been through several things we'd categorize as tropical storms, things that have developed that have been choppy, and maybe 3 periods of high-level hurricanes. So we're in the midst of third, and we're proud and humbled to be your umbrella and doing what we can to be your protection throughout this storm. And we look forward to getting through the rest of it with you and on into the future. So Thank you once again. As always, want to leave you a reminder to get with us. So if you want to talk about the market or your portfolio in depth, please get a hold of your advisor. And Andrew and I are always happy to get on the call and talk about it with you. 800-928-4001 or scan the QR code and book it digitally. And we appreciate your time and hope you have a great weekend.